Welcome to this week's podcast. My name is Andrew Wilkinson. For this episode, I'm joined by Eddie Lam, who is the Managing Director for Asia over at Direction Investments in Hong Kong. Welcome, Eddie. How are you?
Yeah, very good. Happy New Year, everyone. And thanks for having me, Andrew.
You're very welcome. So, Eddie, let's get straight into this. It's been a mixed start for global stock markets. At the turn of the year, US markets were hovering around all-time highs. How were Chinese benchmarks performing by way of comparison?
So the overall equity markets had a rough start of the year and basically underperformed the US market, European market. Say, for example, like CSI 300 and MSCI China was down about 3 to 5% in US dollar terms. I think the market, generally feel that there's a couple of reasons that attributed the downside. First, I think on 6th or 7th of January, the U.S. Department of Defense added Chinese tech giant Tencent Holding and battery maker CATL to the list of companies that associate with China military. So on a single day, Tencent was down 7%. Second, what happened about the tariff on China exports goods? Return back to the White House on 12th of January. I think the third one is the continued depreciation of the Chinese currency, where CNY reached 1.5 years low. So I think that all attribute the recent downside, and so it's basically underperformed the broad market.
Let's turn the clock back a little bit to September 2024, when the Chinese government seemingly moved decisively to stimulate the consumer, the broad economy, and arguably to boost confidence in the stock market. What are some of the views today, Eddie, from local institutions regarding the outlook in 2025 for both China's market and economy?
Yeah. So during the Chinese equity rally in September last year, the Hang Seng Index up 35% in less than 20 trading days. And 14-day RSI rose to 91. Definitely it was overreacted, overbought. So during that rally, we saw that some investor or hedge fund had to cover some of the short positions. And we also noticed that some allocator who had been underweight China for quite some time underperformed their respective benchmark. So those investors have to increase their exposure on China from less overweight, and also some of them may overweight to neutral. And we saw substantial, unit creation of the Hong Kong China ETF, both listed in Hong Kong and especially in the US, with a huge creation. And 5 months after now, lots of, market participants, they encourage to see more monetary and fiscal policy stimulus. But yet people are unsure whether those policy will be enough to restore the investor confidence in the short term. But market participants expect definitely to see more monetary and both and as well as fiscal policy in 2025. So in terms of the GDP expectation, Chinese government would like to set the GDP growth in 2025 at 5%. But generally speaking, the market participants expect that the Chinese economy will slow down in 2025, probably down to 4.5%. But having said that, the general consensus of the Chinese, equity performance may not be that bad. According to Goldman Sachs research, the CSI 300, the forward PE is about 11 times, and the CSI and the MSCI China, the forward PE is about 14 times. So, and by foreseeing this decent earning growth, Goldman Sachs actually expect that both indices could have potentially upside will be approximately 20% for 2025. So those with the upside will support by falling interest rate in China. Probably there's more share buyback and higher dividend payout.
That sounds a little less rich than the US markets, Eddie, at this point. Okay, can you expand a little on the corners of the Chinese stock market in index terms? What are the common indices that are most appealing to investors there?
Yeah. That's like many, but I highlight feel, major indices. I mean, the first one will be CSI 300. So it comprises 300 largest Asia stock listed on Shanghai Stock Exchange and Shenzhen Stock Exchange. Basically, financials, industrial, and communications make up of about 57% of the indices. So those stocks are all listed in China. The indices will be MSCI China Index. So it mainly captured the large and mid cap. So, and those stocks could be listed in China, A shares, in X shares, in Hong Kong red chips, or ADR. Consumer discretionary, communications, and financial constitute around 70% of the index. So, and within this index, it has about 581 constituents. And the other one would be Hang Seng Index. So it consists of 83 constituents. And then all those stocks include Hong Kong and China stock, and all are listed at the Hong Kong Stock Exchange. And the other one that I will also highlight is the CSI Overseas China Internet Index. Especially, we also see a lot of inflow during the September rally last year. So these indices, those companies primarily focuses on the internet or internet-related technologies. So those companies could be listed in Hong Kong Stock Exchange, NASDAQ, or New York Stock Exchange. So those are the couples that are quite popular indices among institutional and retail investors.
What markets or products do you see the Asia investor trading most?
So in Asia, we find that investors remain relatively still positive on U.S. equities quite some time due to solid earning growth, the AI development, and the relatively strong economic numbers. When it comes to ETFs, we see that investors generally like income theme, enhanced return. And I think the last 2 years, couple of core strategies have become more popular. Additionally, we also observe that, there's a more retail investor participation, technical traders on using leverage inverse ETF, especially on certain sectors like technology, semiconductor, U.S. Treasury, and single stock.
What about appetite outside the region? We find here in the United States, investors from all over the world love the liquidity of US markets. Do you see much appetite from Asia, from investors in Asia for outside the region? And if so, whereabouts?
Yes, we do see a lot of Asian investors that favor both trading in US market, given the liquidity, the breadth and the depth of the market. And also many domestic market has been underperformed the US market for a number of years, especially if we see like Korea, Taiwan, or even Hong Kong. We definitely see more the investor exposure has been allocated more to US market. It seems to me that the trend is still feels the same, and still investors are still quite confident on the U.S. economy as well as the U.S. stock performance coming years.
Yeah, that's been a very common theme, really, that we've seen several people mention some of the themes that you've talked about there with Chinese equities being underweight, underinvested in, and whenever we've seen that snapback, it's been pretty violent, hasn't it?
Yes, according to research, the underweight has been improved a bit. I think probably given the rally, some investors don't want it too much underweight China because, when China market rebound, it could become very fast and very sharply. So we saw that the underweight have been improved a bit. And we also noticed that still there's a lot of investors is really looking on what happened about the stimulus policy. Investors would think that it would take time to restore investor confidence. Definitely, again, the tariff is a key factor. So, but then we do see that like investors looking into China market and potentially see maybe when is a good time to re-enter the market.
Very good. Eddie Lam, Managing Director for Asia in Hong Kong with Direxion. Thank you very much for being my guest today.
Thank you, Andrew.
And to our listeners, please don't forget, subscribe wherever you download your podcasts from. Thanks, everybody. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. There is a substantial risk of loss in foreign exchange trading. The settlement date of foreign exchange trades can vary due to time zone differences and bank holidays. The interest rate on borrowed funds must be considered when computing the cost of trades across multiple markets. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.